Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. Today we're talking about the Strait of Hormuz, and more specifically, what a closure of the Strait of Hormuz means for counterparty risk across the global supply chain. A lot of people are looking at commodity markets and stock markets and concluding that the risk is modest because prices have not moved enough to suggest real panic. I think that conclusion is hugely misguided. Markets are not always efficient in the short run. Sometimes they're simply complacent, and when that complacency is built on a poor understanding of linkages in the real economy, the repricing can be sudden and severe. Strait of Hormuz is not some distant geopolitical headline with only a marginal effect on the economy. It's one of the most important choke points in the global trading system. A meaningful disruption affects energy first, of course, but it doesn't stop at energy. It moves into shipping, insurance, petrochemicals, fertilizers, manufacturing inputs, transport costs, food prices, and ultimately corporate earnings and sovereign balance sheets. And this is where counterparty risk enters the picture. Most people think counterparty risk is a banking concept. Well, it is, but it's really about, will the other party perform? Will they pay? Will they deliver? In a supply chain, counterparty risk is a much broader concept. It includes whether your supplier can actually obtain raw materials, whether the supplier can get the feedstock, whether they can secure insurance, get a vessel to even sail. Will the port accept the cargo? Will the manufacturer operate with intermittent inputs? Whether the customer at the far end has the liquidity to take delivery when costs have doubled. In a tightly coupled system, one failure creates another. And that's the piece that many equity investors miss. They look at a company with a diversified vendor list and think the risk is contained, but diversification on paper is not the same as resilience in practice. If multiple suppliers depend on the same energy corridor and the same marine insurers and the same refined products or the same chemical feedstock, then you don't really have independent counterparties. You have correlated exposure disguised as diversification. A closure in Hormuz doesn't mean every factory shuts down tomorrow morning. That's not how it works. There's a lag. Cargoes already in transit continue moving. Inventories buffer the shock for a period of time. Companies rely on safety stock, substitute routes, emergency procurement, and for a brief window, the financial markets can wallpaper over and issue a reassuring story. Because of that time lag, the physical disruption is still propagating through the system. The absence of immediate pain gets interpreted as proof that the risk was exaggerated. In reality, the delay is a feature of logistics. It's not a sign of safety. And once inventories begin to tighten, the stress becomes nonlinear. If diesel prices spike, trucking costs rise. If bunker fuel rises, ocean freight rises. If petrochemical feedstocks are disrupted, plastics, resins, solvents, industrial materials, they get squeezed. And if fertilizer inputs are impaired, that impacts agriculture with a delay. But the delay is not immediate. You won't see this until the harvest next year when yields are down 30% or 50% in many markets. Then companies start triaging who gets the limited supply, which customers are strategic, which ones get preferential treatment, who has the strongest balance sheet, who's going to prepay, who gets cut off. That is the counterparty risk in the real economy. You may have a signed contract and still not receive the product. You may have receivables that look current today only to discover your customer is one missed shipment away from breaching a covenant. You may have a contractor on a development project who's technically solvent but unable to source equipment, wiring, pipes, membranes, or glazing, or anything close to their quoted price. Real estate developers and investors often believe they're insulated from global supply shocks because they own local assets. But construction is a global supply chain business. Mechanical systems, electrical components, copper prices are up over $6 a pound. We haven't seen prices that high in a long time. If counterparty risk rises across the chain, your project budget is at risk, your schedule's at risk, and your lender relationship's at risk. And so is your exit timing. It's not theoretical. It shows up in delayed deliveries, in change orders, in higher contingency, in defaults by subcontractors. And even with that, many public markets are still behaving as though this is a headline risk, not a system risk. And that is complacency. The complacency comes from thinking in straight lines. People imagine that if oil rises by 10%, costs rise by 10%, but the real system doesn't behave that way. When deliveries become uncertain, the economic linkages tighten very quickly, and that's why misplaced complacency is so dangerous. Markets that have not priced the second and third order effects are vulnerable to repricing when those effects become visible. So what should investors do? First, map the exposure beyond the first supplier. Second, assess which business plans rely on just-in-time delivery or thin contingencies. You want to be looking at counterparties with strong balance sheets, with real operating redundancy, with pricing power. You've got to remember that in a stressed world, access to essentials outranks financial engineering every time. Governments may try and blunt the pain by printing money, by lowering taxes. And yes, you can print money, but you can't print oil and you can't print food. If there's not enough, at some point, someone is going to go without. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.